love the channel and find it useful in becoming a happy retiree. Subscribe today. We're going to talk about a concept that is extraordinarily powerful right now. It's the real power of dividend investing. It's called yield at cost. And that helps us break through all of the tension that's in the world. A missile launch in North Korea this week to Japan. Markets didn't seem to care at all, but nonetheless, I would say disconcerting. Healthcare, everywhere you slice it, replace the skinny bill, the better way bill, all dead on arrival, gone. Let's move on to taxes. We talked about the Trump PR tsunami you're going to be hearing about in coming weeks. This week, the Fed did basically nothing in the July meeting, so they left rates the same. Earnings continue to be through the roof. We talked about Samsung and Caterpillar and McDonald's and Boeing, all tremendous numbers, and we are out of an earnings recession that lasted in 14 and 15 and 16 and now 2017, first quarter profits from companies, which is really what matters for the stock market, up about 15% year over year. That's a giant increase. It's a very real number. Second quarter that we're about halfway through reporting, another double-digit type growth rate for profits. We're going to finish this quarter likely in the 12, 13, maybe 14% when it's all said and done in as far as earnings growth. That supports this market. And the primary reason why you see markets, despite the scariness of the world, North Korea, despite the dysfunction in Washington, healthcare dead, you continue to see markets grind higher. What we want to focus on, though, is a longer term, more powerful way to think about investing than just looking at this animal on a week-to-week basis. And that has to do with yield at cost. What is it? Yield at cost is an investment's annual dividend today divided by the original purchase price. So what you paid for the investment. And I'm going to go through some math, give you some updates on companies that we looked at around a half a year ago or a year ago here on Money Matters. So yield at cost, as I just mentioned, it's really just the annual dividend that you're receiving today if you own a company, divided by the original purchase price, what you paid for the investment. So it's really just the math. It's just simple math that can be applied. It's really to any investment. It could be real estate, but we're talking about this in the context today of owning stock. So a stock's current dividend amount divided by what you originally paid for the stock. And I'm going to give you a couple of different examples for this. And remember, you don't buy a dividend paying stock just for the dividends. Remember, total return, we're all after total return. It's not just income. I talk a lot about income, dividends, interest, distributions, but really we're in this game together for total return. And total return simply is growth plus income. The reason we focus on the income piece is you can control that piece. Growth is more at the mercy of a market at any given year or span of time. Good economy, good earnings in general, markets lift. We've been seeing that. You can control the income piece, though. So we don't buy dividend stocks just for the dividends. We expect the underlying stock price to go up, to appreciate over time, as well as paying some sort of quarterly dividend. And what gets overlooked most of the time is how much income you're currently receiving in relation to what you started with. So, and again, the reason I'm bringing this up here is that as this market continues to bump towards all-time highs and grind higher and higher, it's important to understand and remember that we're not just investing just for yield that we can find today. Not just the dividends that I can get if I buy a stock today, the current cash flow, but the true cash flow yield that will grow over the next 5 years and 10 years. As an example, Lockheed Martin, just for a second. Go back to 2007, so let's call it 10 years ago. Lockheed Martin was around $100 a share. $100 a share. Today it's $290. So there's been lots of growth and capital appreciation, but this is what I think is most impressive. In 2007, Lockheed Martin was paying about 35 cents per quarter. So let's call it $1.40, $1.40 per share on $100, right? So yield was about 1.4% back then. But they've had significant dividend growth, what they pay out to shareholders on an annual basis. Today, They pay $1.82 per quarter. That's $7.28 per share. Now, new shares are about $290. So if you want to buy a new share of Lockheed Martin, it'd be $290. The yield today, not a terrible yield, but only about 2.5% today if you bought it as is. Again, that's a decent yield in its own right, but take a look at your YAC, yield at cost. Your current dividend divided by what you originally paid. So the current dividend is $7.28. You paid $100 a share back in 2007 when you bought it. That's almost a 7.25%. It's over 7.25%, 7.28% on your yield at cost. That's really what you're getting from your original shares. That's a wow statistic. Never mind the stock's gone from 100 to 290 in about 10 and a half years. That's a 190% return in itself. If you look at the total return with dividends included and reinvested, 10 grand would have turned into $44,000 or a 339% return. That's about a 15% compounded rate of return on average using if you look at a total return calculator. So it's not just the price going up, it's the price plus your original dividend and your current dividend. Disney is another example. Let's go back to 2008, $30 a share, paid 35 cents. Today it pays 78 cents twice a year. So it pays $1.56 per share today. It's around $110 a share now. About another 1.4% current yield. But let's look at the YAC, the yield at cost. $1.56. Again, the dividend today compared to a $30 share price if you bought it back in 2008. Now, that's a 5.25% yield at cost from the original 2008 price. You buy it today, you're a brand new investor in it, it's a 1.4% dividend yield. If you bought it back in 2008, your yield on original cost or price is 5.2%. Again, stock's gone from $30 to 110 in 9.5 years. That's about a 250% return in its own right. If you look at total return with dividends included and reinvested, 10,000 would have turned into 38,000 or a 283% return. Again, about 15% a year. IBM, same thing. 2007, $95 a share. Today, let me check this. I did this a little while ago. What's IBM today is about $144 per share. So you get 2007 dividend of $1.50. Today it's $6 a share. So they've gone from $1.50 up to $6 a share. Today the yield for IBM is about 4.1%, but the yield at cost, if you bought it back in 2007, it's about 6.3%. And this story just continues and continues. Johnson & Johnson, another great example. But that's really the power of being a dividend investor. It's not just the price going up. It's the amount you're getting per dollar you originally invested in. And that, to me, is the powerful dividend story that never really gets told. So think about the long-term power of what your yield at cost will provide over the next 5 and 10 years. If you are really thinking about income when you stop working at 60 or 62 or 65 or 60 or 70, whatever that age is, we want our stocks to be paying us and replacing the paycheck that we had while we were working. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.